Good morning, everyone, and thank you very much for joining this session, which will focus on ESG risk assessment in fixed income. Many of you who are sitting here today have probably passed the stage of asking why you should be worrying about fixed income and ESG risks, and asking instead yourself why and how you should be implementing the analysis. And you're actually in the right session, because today we're going to discuss what are the tools available to you, what is out there in the market, what is missing, and I'm hoping that you're walking out of this session having learned something new, or with a few questions that you might start asking to your investment managers if you're an asset owner, or for yourselves as you start thinking about how to put in place a framework or a process around risk assessment. My name is Carmen Nuzzo. I'm a senior consultant at the PRI. I've been working on the ESG in credit ratings initiative over the past year and a half. The idea behind this panel today came out of all the work that we've been doing since the launch of this initiative, which started 2 years ago, when the PRI published a statement called ESG in credit ratings, which is just a one page that investors and credit rating agencies sign. And by doing so, they take a commitment and they endorse the principles of the PRI, of course, but also they commit to be more transparent and more systematic and strategic about considering ESG factors when it comes specifically to credit risk assessment. And as you know, in fixed income, credit risk is one of the major risks that can affect bond performance, being the probability that an issuer might not be willing or able to repay the debt promise linked to the bond that it has issued. So the initiative has gained tremendous traction. We've got 137 investors signed up so far. The last one was on Monday morning, so the numbers continue to increase. Collectively, they manage 27 trillions of assets in dollar terms. And what's been most astonishing has been the growth in the number of credit rating agencies that have endorsed the statement, which has nearly trebled from the initial 6. We're now counting 17 credit rating agencies. And among these supporters, we count big players such as Moody's Investor Service and S&P Global Ratings, who have been among the founders of the statement, the initial supporters of the statement. I'm glad to announce today that Fitch group has also joined 2 weeks ago. But we also work with smaller credit rating agencies that are either small because they cater for certain products in particular, or because they cater for a regional community. You have the whole list on our website. I'd suggest a few who are here also today beyond ratings who focus on sovereign bonds. They're not actually registered yet, but they're working towards that. There is Spread Research. We've got Liberum in Brazil, RAM in Malaysia, 3 Chinese credit rating agencies. The initiative is truly global. So this is, in a nutshell, the progress that we've made so far, and then I'll hand over to the panel of today. I'm just trying to set the scene here to give you a bit of background of where we're coming from and why we decided to discuss what we will be discussing today. After the statement in 2016, we formed an advisory committee made of 18 members, some of whom are here on this panel. They represent both investors and credit rating agencies, and with their help, in July of last year, we published the first report of a 3-part series: Shifting Perceptions, ESG, Credit Risk and Ratings, the State of Play. What that report wanted to be was a snapshot of what credit rating agencies and investors are already doing in the space, where they're coming from, what's already embedded in credit risk analysis, because many ESG factors have traditionally been there that may not have been labeled as such, but also what's missing. And on the back, after the report, or during the drafting of the report, we noticed actually that there were 4 main disconnects between investors on one side and credit rating agencies on the other side that helped us to form the discussions around the string of roundtables that we have organized globally. So we've done roundtables since September of last year. We've organized 15 of them. And this were a unique opportunity for credit practitioners for the first time, both on the investor side and the credit rating agency side, to engage specifically and discuss ESG topics. And the result of all this work was in the publication that we've issued in June of this year, which is not surprisingly called Exploring the Disconnect. I'm not here to give you the summary of these reports because I want you to read the reports, at least the executive summaries, but I'd encourage you to take a look at all the case studies that we've published, drawn from investors' experience, and also many examples that we've drawn from research that credit rating agencies have started to put together, or examples of changes in outlooks that take into consideration or to which ESG factors may have been contributing, either in opinions or changes in outlooks. So I said I won't summarize the conclusions of the reports, but I wanted to highlight the four main disconnects that form the basis for our discussions. The first one was the materiality of the ESG risk case. What affects default risk and what doesn't affect default risk? This is very important because sometimes investors focus on the overall bond performance, but they forget that credit risk is purely about default risk. Secondly, the visibility of ESG risk. How far into the future should we go in the analysis? And here there were some disconnects in views between investors and credit rating agencies that we discussed at length. Thirdly, the approach. Should it be a bolt-on approach or an add-on approach? Should it be a baked-in analysis or a separate analysis? And finally, how do we bring the industry together to be better at communicating and speak the same language? This is the slide that illustrates all the countries that we've covered so far with the roundtables that we've organized. The two missing areas that we haven't reached out to yet are China and Latin America, but we've been pretty much everywhere around the globe with some interesting insight also about regional differences. What, in a nutshell, these roundtables have helped them to do is provide a forum for peers to discuss and have the time and the space to think about these issues because they're all new, as you know, in fixed income analysis. Secondly, more than disconnects, these turned out to be shared challenges, which both credit rating agencies and investors are now facing as they formalize or put together a framework, a more quantitative framework around this type of analysis. Thirdly, they're acting as catalysts for very important developments by credit rating agencies, and you'll hear more about this during the panel. And finally, we are starting to address some misconceptions, which are very important to clarify. The first one is that ESG consideration in credit risk analysis is different from measuring the ESG exposure of an issuer. That's different, and that's the idea behind today's panel. That's why we want to discuss what different tools you have available and what they measure. Secondly, that evaluating a bond secondly, that ESG in credit risk analysis is different from rules-based investing. It can include rules-based investing, but it's not necessarily driven by exclusion or ethical norms. And finally, this is an issue that comes up repeatedly. This is not only about green bonds. It's also about green bonds, but green bonds are a small or big growing fraction of the fixed income universe, but it's about pricing all ESG risks that may affect any fixed income asset. So with that, before handing over to the panel of today, I would like to pose to the audience, just as an icebreaker, two questions that will help us to form also the discussion of today's panel. The first one is, and I'm hoping that at the back, technology will help us because I always get very nervous when it comes to this point. So the first question is, when if you've started already to think about ESG in credit risk, or in general, ESG risks in your portfolio allocation, which source do you use? Oh, it doesn't show the question? Sorry, you don't have the question? Okay, I knew it. That's fine. All right, we'll come back. I knew every year I say, I'm not going to do this. I fall into the trap. But anyway, we can't even do a show of hands, but that's all right. So with that, I'm going to hand over to to the moderator of the panel of today, who's My-Linh. She's head of ESG investment at BlueBay Asset Management. She is also the chair of the advisory committee on the Credit Ratings Initiative, and she devotes quite a lot of time on this project. So I'm really grateful to her for being here today because she's here in a triple capacity as a moderator, as an investor, and as a chair of the advisory committee. So that's great. So, and My-Linh will introduce to you the rest of the panels. So just before we do that, when can we have these polls, Megan? When, towards the middle? Okay, all right, maybe after the, yeah, we come back. I'll stay here. All right, okay, thank you. There you go.
for that useful overview, Carmen, and sort of bringing us up to where we are on the project. As she sort of mentioned, my name's My-Linh, and I'm going to be your moderator and participant today. My role is very much at BlueBay, is to integrate ESG into our investment activities. BlueBay is a specialist fixed income house. Assets under management total over $61 billion US. And we're very much involved in the whole spectrum of fixed income. We do public and private debt, we do sovereigns, we do corporates, and we're involved in all these sub-asset classes. In terms of my personal background, I come from ESG equities. So the last 4 years has been a big, steep learning curve in terms of getting my head around how it sort of works in fixed income. So I feel the pain of a lot of people who've been working on this. And I think that actually it's been really important for me to actually understand and step back and look at the asset class from a technical perspective. Yeah, okay. Because I've realized that actually the way that I'm communicating my analysts and my frustrations has been that I've assumed that what has worked in equities has worked in fixed income, and that's simply not true. So I've really sort of had to take a step back and think about that, and then work out why things are not working in terms of some of the narratives I've been doing. And actually the PRI initiative has been a really important sort of space for us to think about that. So I'm really grateful to the PRI for organising the initiative to allow us to think about this sort of issue more strategically, which I think is really important, because sometimes when you're doing this job, you're firefighting all the time, and you don't always get a chance to have that space to reflect, which is really important. So in terms of today's session, as Carmen sort of indicated to you a little bit, what we're planning is that I guess we're going to focus on the ESG data information aspect of the credit analysis. And we're going to look at that from two aspects, in terms of the demand side, in terms of what investors are doing, using, thinking. And then we're going to look at it from the supply side, in terms of who are the providers of that information, what are they planning, what are they thinking about it, in terms of whether the products need to be different to those they offer to their equity investors at all. In terms of the format of the session, what we were thinking is about 30 minutes of facilitated discussions with our panelists, and then we'll have 10 minutes of questions from the audience for the panelists, and also we're keen to get your thoughts on some of the things that we've talked about today. And then I'll hand back to Carmen to wrap up in terms of next steps for the project, and then hopefully give you plenty of time for the networking session, as it were. I just want to check in terms of housekeeping that people have got their phones on mute. That would be great. And then I guess all that's left for me to do before we kick off is actually introduce the panel. I thought they're in a better place than me to introduce, so what I'll start off with is maybe Mike from the far side and work our way in. If the panelists could sort of say their name, their organisation, and then give the audience a sense about what is their role within their organisation and how they interact in terms of the fixed income side. Mike?
Yeah, thanks, My-Linh. I'm Mike Wilkins. I'm head of sustainable finance at S&P Global Ratings. My role is to head up a team of around 20 financial professionals focused on ESG, climate change, risk analysis, and other areas related to sustainability. I've been following the sustainable finance and ESG matters for well over 10 years, and I've been at S&P for over 25 years now. So that's my role.
Hi, my name is Mervyn Tang. I head ESG fixed income research at MSCI. So at MSCI, we provide investment tools to really help the demand side invest. That's not just ratings and scores, but also indexes, portfolio analytics, portfolio reporting. So really just we develop the tools to really meet whatever ESG demand there is. As a public service announcement and for transparency reasons, I was formerly at Fitch, so I do have a perspective from the credit rating side as well.
My name is James Rich. I am a portfolio manager on a number of fixed income strategies at Aegon Asset Management. We have about $400 billion of assets under management globally, of which about 70% is fixed income. So we're heavily focused on fixed income, and I've been heavily involved in the integration of ESG research and factors into all of our strategies within Aegon on the fixed income side. And I've been at Aegon for about 10 years.
Great, so a pleasure to be here. My name's Nikki Gwilliam-Beeharee, and I work for a sustainability rating agency. So we're called Vigeo Eiris. We're headquartered in France and have a historical roots in Europe, but we have a global footprint. That means in terms of our ESG research, as well as our client base and our workforce. Myself, I'm on the research side, so I'm the director of research. That means I lead a big team. We have 150 ESG analysts around the world, and we work on a day-to-day basis to deliver and develop our products for our clients. Just to say on the fixed income side, we split our products and services on fixed income in two categories. So those that directly serve investors and those that are directly bought and commissioned by issuers themselves. So on the investor side, we cover 3,000 issuers with ESG research, which is on issuers that have issued some fixed income issuances. So that's corporations, but also development banks, sovereigns, some local authorities or state authorities. And then on the issuer side, we do give second-party opinions on green and social bonds. We've been doing that since 2012, so in this booming market. It's exciting to hear the announcements yesterday for the California market. But more recently, and I think what's really interesting in this fixed income space at the moment, is on the issuer interest that we're seeing, and the issuers are working directly with us. Those that are not publishing green or social bonds, but that do want to publish their sustainability rating to access this market. So.
Thanks very much, everybody. Okay. That's all right. That's fine. Before we do the questions, I think what it's got here is that we've got a very qualified panelist. We've got diversity. So we've got two providers from the ESG research provider side. We've got Mike, who's going to be very ably representing the credit rating agency side, and then James and myself on the investor. But it would be really good to get a sense about who's in the room here so that we can get a sense for maybe some of the questions that will come out and what might be thinking. So can you do, by a show of hands, please, those of you who are in the room that are on the sort of demand side in terms of investors as asset owners and asset managers, can you put your hands up? Okay, it's over about half the room. Okay. Thank you. Can you keep your hands up, please? And then put them down. Put them down if you don't have any fixed income exposure at all to your business. Okay. Not bad. Half of that or so. Okay, thank you very much. You can all put your hands down. And then in terms of gauging who in the room are what I guess would be the data provider side, whether you're on the sort of traditional ESG like MSCI and Vigeo Eiris, or whether you're on the credit rating agency side, as it were. Can you put your hands up? Okay, quarter, not bad. Thank you. And I'm guessing the rest of you are a mix of investment consultants, independent sustainability consultants, NGOs, and academics. This is another group out there, media as well. Excellent. That's really helpful for us because I think it'll give us a bit of a context about what we're making in this area. So before we start the panel, I'm told now we have the questions. Yeah? Okay, so I think for you to be able to vote on it, it should be on your app. That if you go to your the app for the session and click into there, I think towards the bottom there's an icon to click. Yeah? Anyway, but I think the questions will show up on your thing on there.
You need to read out the question.
I think it's the second question.
Yeah, okay. Just read the question.
So we've got two questions. So the one that I think we're seeing the votes on already here
so bad. Yeah, okay.
is something that we're looking at in terms of terminology, which we'll touch on in a little bit. Is that the word ratings has been used interchangeably when we're talking about credit ratings and we're talking about ESG ratings. And we just want to understand from the point of view of the audience, does it matter what term we use or is it confusing? So what we've got on this slide here in this poll was to ask you to vote potentially different terminologies for information that comes from the more traditional ESG research providers, as it were, what terms you would like to have. So it's interesting from there that obviously I think about, it keeps changing, but roughly a third of you either have no strong opinions, which is really interesting, and then ESG assessment seems very popular as a second choice. Evaluation is sort of getting the least. And then ratings and then scores actually is only sort of 10 to 15. So that's really interesting. And it might be quite interesting to do this poll after the discussion as well to see whether we've been able to persuade you either way, as it were. Now we've got another poll, hopefully that will show through. be, which was asking you, I guess those of you who were investors in the audience, what is your primary source of ESG credit information that you utilize? So we appreciate everybody uses a wide range, but we wanted to get what is the primary source of information input that goes into there. So, okay, overwhelmingly, we've got the likes of Vigeo, Eiris, and sort of MSCI, and then proprietary research, so in-house research. I think that's really interesting as well. And the credit rating agencies are only 3%, so I think we'll have a conversation there with Mike and find out what's happening on that side, as it were, given that's the primary focus of what you do on there. So thank you very much, guys. That's really helpful. So. Let's get on with the panel discussion, because you don't want to hear any more from me. We want to hear from the guys here. So let's sort of focus on the demand side in terms of investors. What are we doing in this area in terms of looking at the data and utilizing the data and sort of transforming it into something that's helpful to investment decisions? So my first sort of set of questions are really on the investor side, so it'll be James and myself, if that's okay, and then we'll move on to the provider side. So James, maybe just a question to set the scene. You're from an asset owner. Why is Aegon looking at ESG in your investment process? What are the drivers? Is it ethical? Is there a business case? And if there is a business case, is it just about risk, or is there something else?
Yeah, so first I'm going to comment only on the fixed income side of my business. As I said, that's about 70% of our assets, and my personal exposure is to the fixed income side. But generally speaking, we believe as a firm that integration of ESG is part of our fiduciary duty to our clients. And then if you're not integrating ESG into fixed income decisions, then you're actually not doing your fiduciary duty. And from our perspective, in terms of why we do it, I mean, we do see it as an opportunity and also as a way of avoiding risks as well. At the end of the day, when you are long a fixed income security, you're essentially short a put on the enterprise. And so you have to focus on the downside. But the upside is also important to us as well, because there's plenty of bonds that don't trade at par. They trade either meaningfully below or meaningfully above par. And so being able to capture that upside to us is alpha. And to some extent it is downside avoidance, but it's also the opportunity to capture alpha. And if our competitors are not integrating ESG research and factors into their investment processes and into their investment decisions, then that's an opportunity for us to outperform our peers. So to us, it's core to our DNA. And as I said, we believe that it's our fiduciary duty to integrate this into our research and investment process.
Thank you, James. That's really helpful. I guess from BlueBay's side, we're very much sort of viewing this as a business case, as it were. We think this can add value to what we do. I think it's really interesting when I've spoken to investors and other key stakeholders, the presumption is that we're doing this from a risk perspective, and to some extent we are, because we're fixed income. Our upsides are capped. We know from day one what we can get is the optimum outcome, but obviously our downsides are unlimited. So it is risk, but I think I would very much concur with James is that the alpha opportunity is there. And where that comes in is in terms of using the ESG insights to identify whether the market is pricing or mispricing ESG risks appropriately. So sort of identifying market inefficiencies. So I think it's actually right to talk about both, and I think it's something that a lot of people who are outsiders to this industry think it's all about sort of downside risk. So I think it's a really important thing to highlight. Moving on to maybe the next question is that, so you think it's important. How are Aegon sort of approaching this in terms of your internal framework to integrate the data into this, and who's doing it?
Yeah, so this is an important topic, and I think a lot of firms have taken different approaches to this. From our perspective, because as I said, we believe that it's essentially it's part of good credit research, and if you're not doing it, you're actually not doing your job as credit research folks. We believe that the integration of ESG has to happen within the investment team rather than having a separate team that just looks at ESG risks and determines how it impacts the fundamentals of the company. So from our perspective, the credit research analysts are the first ones who do the ESG integration, and then they have conversations with the portfolio managers, and then jointly the portfolio managers and the research analysts make the decision as to whether or not it reaches a level of materiality to be meaningful to the fundamentals and ultimately the price and the spread of the bond. But as I said, the most important thing for us is that we fundamentally believe that the credit research analysts are the ones who know and understand these businesses the best. and the issuers the best. And so to not have those folks be the ones who are actually doing the research and integrating it in, from our standpoint, just wouldn't make sense. In terms of how we actually do it, we have a proprietary model that we essentially use in-house, where we effectively bucket the risk factors that we determine that are ESG related, and the buckets are based on the level of materiality. So the more material it is to the fundamentals and ultimately the price or the spread of the bond, the higher the bucket it will be in. And then the higher it is, the more it gets integrated into the investment decision, with the research analyst making a recommendation to the portfolio management team, and then the portfolio management team and the research analyst integrating that into the ultimate investment decision.
Thank you very much, James. Sort of with my BlueBay hat on, is what I'd say is that we would also concur that involving the analyst is absolutely key. But what we've got is that we actually, my team works very closely with the credit analysts. Maybe it's a function of where we are at the moment, that I think the theme that was touched on earlier about sort of credit analyst training and knowledge and awareness, we feel we can't leave them to do it in isolation because they're not really close enough to really calibrate the ESG risks appropriately, or interpret and sort of sufficiently evaluate the seriousness of some of the ESG risks, because they don't understand fully the underlying sources and the signals, as it were. So we are an integral part of that process. Our approach is very much risk-based as well, I think, James, on that side. What we've just introduced last month is that we've rolled out a formal issuer ESG evaluation process across all of our public debt teams, investment teams, for sovereigns and corporate issuers. What we've got is a framework where we're using external data from the likes of MSCI and Vigeo Eiris as an input into that process, but then it's overlaid and built on top by our credit analysts' knowledge and insights and the ESG analysts to come up with 2 data points. And I'd like to describe that a little bit, because I think it's quite interesting how we've arrived at that potentially, and I'd be interested to see how other people think about it. Is our 2 data points are, one, we're calling a fundamental ESG rating. Now that is issuer specific, it's unique to the issuer. There can only be one fundamental ESG rating per issuer. So if that issuer is covered by more than one desk, all the analysts have to come together and agree a rating for that. That works on a 5-point scale from very high ESG risk to very low ESG risk. And that assessment is nothing to do with investment. It's purely an assessment of the quality of the management of the material ESG risks that it faces. That score, that rating, is co-owned by the analyst and the ESG analyst. So what happens is the credit analyst initially proposes a provisional rating, and then the ESG team actually affirms that, or we have a discussion to come with a revised score. Then what we have separate to incorporate the investment aspect is what we're calling an investment ESG score. Now this is really important. An issuer can have more than one investment ESG score. That score is decision-based and it's instrument-based. We're doing that because we recognize the fact that within fixed income, different from equities, you don't have a single credit risk profile. You have different bonds you can invest in for that issuer with different investment risk profiles. So we've deliberately disaggregated the investment impact from the fundamental perception of risk. So we're allowing investment teams and analysts to actually generate different scores for different bonds and different decisions across different desks for the same issuer. So we're really interested to see how that will play out, and whether that there'll be a correlation between the 2 different data points, and potentially whether there might be different investment ESG scores amongst the different investment analysts on the desks as well. So I think that's one way that we're trying to think about this in that area. And I guess my last question, maybe on the investor side before we move on, is actually coming back to the point about the data itself, and maybe asking James. We saw from the poll, interestingly enough, the audience who are investors, what are their primary sources of ESG information? Does that sort of concur with what you would prioritize as how you get the data? And maybe this is your platform to sort of get out your asks. What do you think about the quality of that data from the different providers? What's good? What frustrates you? What do you want more of?
Well, it's funny because I filled out the question myself on my phone, and Mervyn was sort of looking over my shoulder as I did it. And initially, I actually said that it was the ESG research firms. And then I saw that one of the options was actually proprietary research. And so no offense, Mervyn. but at the end of the day, for us, the primary source of ESG specific research and inclusion of and integration of factors is actually our proprietary research team. We have dozens of analysts across the world who essentially cover every issuer globally from a fixed income perspective. And so, as I said, I think one of the differences between the way that My-Lin's firm, BlueBay, does it and the way that we do it at Aegon is it's integrated into the actual credit research process, because we believe that whether it's an ESG factor or a non-ESG factor, if it's material enough to impact the fundamentals of the business, either in the short term or the long term, you have to take it into account. And if you're not, you're not doing your job. And so, the first level of information for us is proprietary research. But yes, the answer is we absolutely buy research and data from a number of the firms up here. In fact, I'm sorry to say 2 of the 3 firms. I won't specify which 2, but we do see value in bringing in research and analysis and data from other firms. From our standpoint. To be completely honest, we look at the research that comes out of MSCI and the research that comes out of S&P and the other credit rating agencies the same way that we would look at a research report that's coming out of Goldman Sachs or Barclays. For us, it's another data point, it's another view that someone else has. Different firms and different people interpret and analyze data and information differently. And so for us, it's a way for us to bring in additional perspective into the investment decision and into the credit research. With respect to what each of the firms are doing well and not, which I think was kind of the heart of your question. Obviously, I think the ESG specific firms do a really nice job of laying out all of the ESG specific data, and that actually is helpful to us because it also, to the extent that we miss something in our proprietary research, it's right there at our fingertips for us to look at a report from one of these firms to help us to identify that. But I personally believe that the relation of the information and data that comes out of the ESG firms is not well linked to the actual credit investment decision that we as asset managers have to do on behalf of our clients. On the flip side, I actually think that the credit rating agencies do a reasonably good job of figuring out how to integrate credit factors into the investment decision. They have a number of different analyses that they perform that sort of indicate whether or not something is priced appropriately in the market. But on the other hand, their ESG specific research and data is not as good as the 2 firms that are sitting next to me. So I think for us, it's a combination of both sets of firms that we have to integrate into our process because we think of them as different and unique, at least for now.
I think I would concur with quite a bit of that there's definitely complementary strengths and weaknesses, and that might play out differently in the future as both sides are looking to improve this area, as it were. So I've had a few comments in this area, but I'm just conscious of time, so I want to sort of allow more time for the participants. So I think I'll move on to the supply side in terms of the data providers and sort of get your thoughts on where things are. So maybe I can start off with Nikki and Mervyn in terms of, we've said that we're interested in this area. We think there's value in terms of looking at this. Are we atypical of your investor base clients in terms of asking for ESG credit information, or are we sort of very much amongst a big group of this area? Maybe Mervyn?
Yeah, happy to. Demand on the ESG side from fixed income investors has really taken off over the last few years, but I think it would be very fair to say that there is a head start in the equity space, and hence a lot of the tools and a lot of the analysis was catered initially from an equity perspective. Now, I think when I say that, it's important that both equity and fixed income investors, from an ESG perspective, are looking to analyze similar things in the sense they want to understand the sustainability of business models of the companies that they invest in. How that actually translates into security prices is where there is a difference. And so in that sense, I think if you're thinking about the metrics to gauge sustainability, say carbon intensity, water withdrawal, they aren't going to be different for equity and fixed income investors, but there will be a portion that are. So take example of something like private companies, which will not have listed equity. the considerations that you need to make from an governance perspective and ESG perspective more generally is not going to be catered into, say, an equity-focused model. We would have to take into account private equity ownership or kind of other characteristics of the ownership in space. You might also have to consider the differences in governance for the repayment of debt versus the efficient allocation of capital. So one thing that investors often talk about is entrenched boards. Entrenched boards often have a long track record of paying back their debt investor, but they may not have a great track record of allocating capital effectively. So from our perspective, as we try to cater our model to be more fixed income relevant, we have to manage our research and change our research to meet those needs, to identify downside risk issues, to identify time horizon differences that may have security level applications. And I think that's where our research has been moving.
Well, obviously, with your addition to MSCI, that's very clear that that's a strategic commitment from the organisation. Nikki, is there anything you want to add in terms of, I think when you did your introduction, you alluded to some more fixed income specific products that you
and maybe I can talk, so I talked about the two types of products on the investor side and then on the issuer direct work that we're doing with issuers. But yeah, I definitely would emphasize that we see credit ratings and sustainability ratings as different and something which may be complementary in terms of information and the tackling asymmetry of information in the market. Complementary, and also not interchangeable. And I would emphasize there that ultimately that's because credit ratings, as I know those that are all specializing in this area are very familiar with, credit ratings are giving an opinion on the extent to which an issuer is able to pay back its debt when those payments become due. In comparison, for us, when we do sustainability ratings, we're looking at the extent to which an issuer is able to manage its risks and create value linked to any environmental, social, and governance factor. So when we use that distinction in the fixed income sphere specifically, I would say, and looking at this initiative working with credit rating agencies, we see that sustainability rating agencies like ourselves have at least two roles to play. First, I would say in any kind of initiative like this, it's useful that we maximize and optimize the existing ESG knowledge within the industry. And here I'm talking about the fact that service providers such as Vigeo, Eiris, we have roots back more than 30 years of ESG research, and that means plenty of information for backtesting and plenty of expertise in the ESG arena to talk to and think about how credit ratings can integrate ESG factors into that credit assessment. I mentioned two roles, so just to say on the second role side, what we see as more fundamental and more core in our DNA of a ESG research provider is that we're offering fixed income investors, and certainly we see that with the clients we work with, like those in the equity client base. They want to have information that is broader than credit rating. They certainly want to have information about issuers that enables them and you in the room to manage your own reputation, your own legal security as an investor. We know that our clients and prospects in the fixed income sphere are looking to meet or exceed the demands, the growing demands of their own client base and ultimately their members to integrate sustainability factors. So that's something, not just, I would say, my own opinion on the role of sustainability agencies. It's also something which we saw on the investor side. A group of investors in Europe signed a formal declaration in December last year emphasizing the role and the need to have sustainability ratings as well as other financial players issuing this kind of research. And I think Al Gore also mentioned yesterday the role of the European Commission, so certainly I'm based in London, so I'm hearing a lot about this, the Esg report and the Sustainable Finance Action Plan, which also refers to these different roles of credit rating agencies and sustainability rating agencies.
Thanks, Nikki. I think she's touched on some topics there, which I think we've got as covered a question later on as well, and I think it neatly runs into maybe my question to Mike, who's been waiting very patiently over there, is that, you know, in terms of helping our audience better understand the distinction between the outputs, what's the same, what's different. I think Nikki started to sort of touch onto that in terms of the distinction. But Mike, do you have any colour you want to add on, or sort of maybe more sort of key areas of distinction that you would sort of advise the audience to bear in mind?
Yeah, well, where do I start? We have, for a number of years at S&P Global Ratings, made clear that we've incorporated ESG factors into our credit ratings. And, you know, it's very clear from what we've been hearing already on this panel that there is a distinction between the role of a credit rating and the role of a sustainability score or assessment or evaluation, whatever you wish to call it. They are two distinct, different indicators. But nonetheless, it is important to emphasize that credit ratings do, as far as we're concerned at least, take ESG factors into account where they have a material and visible impact on credit quality. So we're very mindful that debt investors, especially mainstream debt investors, have to take into account a number of different variables when they make their decisions. One of the major ones, of course, is credit, and credit itself is driven by a number of different risk factors, of which ESG is just one of them. So to overemphasize ESG in the credit rating would not make sense, but on the contrary, you know, to underemphasize it or to ignore it equally would not make sense either. So we're very conscious that we need to provide transparency on how we look at ESG, and we've been doing that over a number of years. We've published reports on look-back analysis ranging on over 9,000 of our research updates on companies. So we have over 4,500 corporations rated. And we've looked at all the research updates over a 2-year period to show how individually environmental, social, and we're about to publish now on governance factors have actually impacted ratings in terms of leading to upgrades, downgrades, and what have been the key drivers behind that. And more importantly, where in our methodology we have been able to show that impact affecting the analysis. So that level of transparency is now being provided. I'd like to say it's being provided from the goodness of our hearts, but I would also like to stress that the regulators are on top of us, quite literally sometimes, really forcing the issue. You know, we've heard about the high-level expert group, the Sustainable Finance Action Plan coming out of Europe. You know, we have a number of other financial regulators, you know, scrutinizing us as a regulated credit rating agencies all the time. And the focus has very recently turned onto how ESG is integrated into credit rating. So as a result of that extra scrutiny, as a result of that extra level of focus, which is actually quite tied into politics as well, but I'll save that for another time. But as a result of all that, you know, we are having to deliver far more in terms of transparency in what we're doing. And that's a good thing, I should stress. I mean, we're in no way shirking away from that. I think it needs to be done, and I think it adds value to the financial community. So that's on the level of transparency. I think just one other thing I wanted to add in terms of our analytical insight. I think it was James that mentioned that the credit analysts are best placed to understand ESG risk, and I would 100% concur with that. I think credit analysts who look at companies day in, day out and understand their credits, as we call them, on a day-to-day basis are the best place to look at these risks. That's why we're now developing our own internal ESG analytics further than we have ever done before, and basing that deeply within our credit analytical resource network to help make our analysis even better in respect to ESG.
Thanks very much, Mike. I'm just sort of thinking back to the poll results you saw in terms of where the information for ESG comes from, and as you said, it's part of your process, as it were. Did that surprise you at all, the extent of that sort of how the scores played out, the percentages?
Yeah, I think it didn't really surprise me because I've been involved in the PRI initiative led by Carmen for a number of years now, And one of the resounding sort of feedback points that we have is that not many in the market are conscious of the research that we do and the work that we do in ESG. And it's incumbent upon us as a credit rating agency to make sure that we make that more transparent and communicate better in terms of what we're doing. So the fact that only 3% in the room actually use us for their ESG credit analysis is not a surprise, because I imagine a lot of them don't even know what we're doing in this space. So we're trying very hard to rectify that situation.
Okay, so there's only way is up, as it were,
Yeah,
on
exactly.
there in terms of on that side. I'm conscious of time because I promised you time to have questions. So I think we had a few other topics that we were going to cover, but we can bring them into the Q&A if there's no questions from the audience. So maybe my last sort of set of questions for the panelists then is maybe in terms of thinking about the future, stepping away from where we are now today. If you had a crystal ball, or if you had a wish list of where you would like to see the industry going in terms of ESG credit research in the next 3 to 5 years. So let's not just think in the next year, think in terms of the next 3 to 5 years. How do we see that ecosystem evolving? Who are going to be the players? Will we have the same results if we did the same polls now? Where will it come from? Will there be new entrants to the market in terms of the ESG data intelligence that we're coming up with? How far will we get? So maybe I can start. Nikki, could you be very brief, please, because we're running out of time. Thank you.
So I definitely would emphasize, of course, we have the historical and the growing interest from the investor side, but what we're seeing certainly from European experience is the issuer maturity and motivation to get actively involved in this arena. So I think that's definitely a business trend. That's something for our business model as an organization that we're aligning to, but I think that's also a really positive thing for those issuers to want to provide the information to you, to investors, so you have all the information, credit, ESG information, to be able to make decisions that are just and well managed as we transition to meet these challenges.
Brilliant, thank you. James?
I think that fundamentally investment management firms are going to come to the same conclusion that we already have, which is that it's part of our fiduciary duty. So I think my view would be that longer term proprietary research of ESG factors is going to become more and more important to this industry. That being said, as I said, I think that there's a role for all of the firms surrounding me to play a complementary role in the work that we do. And I think ultimately, like it or not, I think the credit rating agencies, to some extent, we have to buy their research because our clients give us mandates that tell us that we have to run them based on a set of ratings from S&P, Moody's, and Fitch. So I think to the extent that they can actually continue to develop their ESG ratings and data, I think that's going to be very helpful to us. And if they don't, then I think that these firms here are going to have a major role to play on the ESG for a long time to come.
Great, thank you. Mervyn?
Yeah, so I think the discussion we've had here, we've had a very narrow concept of credit risk, because credit risk is not just a single security level concept, it's a more portfolio concept. And we think about ESG, a lot of the things we're talking about are systematic that can affect across the portfolio. Climate change, demographical shifts, they're not just going to affect one security. And so as the industry moves on, we need to understand ESG at a portfolio level, which is what our portfolio analytics, portfolio reporting tries to do. And I think that caters to what James was talking about when trying to price ESG risk, trying to understand ESG risk. I could have two portfolios of the same average credit rating, but wildly different ESG risks. So when I'm making that alpha call, I need a swath of information in terms of ESG available to make that decision. So it's beyond just having an average credit rating and average credit risk.
Yeah.
Yeah, I think from our point of view, we're going to have to continue to respond to market demand. We have done already. When we saw investors coming to us asking not just how credit-worthy their bonds were, but how green they were, we responded by developing a green evaluation service to provide a view on environmental contribution of bonds and loans. So we're now doing the same with ESG. We recognize that the credit rating has ESG in it. We can show where ESG factors actually lead to changes in ratings, but we also know that the market wants more than that. They want much deeper information, they want more data, they want granularity, and they also want a longer term view. The time horizon aspect we haven't touched upon yet is also something which we're focused on. We're very involved with the TCFD, and we're developing a new service which not only looks at how companies as a whole are exposed to ESG risks and opportunities, and looking at that from a stakeholder value perspective, but also looking longer term and how prepared they are to actually manage these risks, and also the level of adoption of the TCFD recommendations. And we'll be looking to launch that product very soon. So we're responding to market demand is the answer.
Thanks very much, Mike. I think sort of came out from those latter two talks, I think, was kept thinking back the disconnects is the issue about materiality and the issue about time horizons. And I think there are particular challenges for that in the fixed income context, because you've got these multiple credit risk profiles, that the answer isn't necessarily as straightforward, sort of it's going to be this sort of thing that will have to play out. Right, I'm just conscious of time, so I want to turn to audience questions. I think looking at time, you're meant to break in about 5 minutes. So if I can maybe, as chair, take the liberty of sort of extending our session by 5 minutes if we need it in terms of questions, I'd really appreciate that. So if you could have a show of hands, I'm going to take 2 questions at a time. If you could, when the mic comes to you, if you could give your name, your organisation, and be as brief as you can with your question. And if you've got somebody you want to direct it to specifically, that would be great. Thank you. In the front.
Thank you so much. I'm Natasha Brzezinski-Mounier from the Capital Group. My question is about separating your assessment for sovereign issuers versus corporate credit. And if Mervyn could start off, that would be great.
Okay, another question? Just grab them 2. Yep.
Great. Raj Kundra, I'm with WWF. I think much of this conversation is about the positive relationship between ESG risk, and I'm mostly focused on environmental risk and company risk, meaning the more ESG risk companies take, the more they are left with overall risk. And I would suspect that's true for a big chunk of the market, probably the top of the market. What about the bottom of the market, where companies that actually take environmental risk have better performance? So think about like a White Castle as compared to a McDonald's, where they win by having lower prices and lower standards. I guess, how do your models begin to think about and address those situations?
Great, thank you very much. So I'm not going to ask everybody to answer those questions. So if anybody's got a very strong view that they would like to answer any of those questions. Yeah?
I can answer the second question that was asked. I think that gets down to time horizon, and that's one of the issues with ESG, integration of ESG here. In the short term, it actually may make sense for that business to do what you just said, which is basically have lower standards and offer a lower price, in kind of exchange. And that may work in the short term, but in the long term, I think it would be our expectation that a firm like that would probably suffer and would be facing a pretty tough hill to climb. So it comes down to time horizon, I think.
And yeah, I can tackle the first one. So I guess there's 2 distinctions we can hear. So there's the ESG assessment of a sovereign bond versus a corporate bond, and then the ESG assessment of the sovereign risk of a corporate bond and the corporate risk, and the more individual risk of a corporate bond. So from the way we do at MSCI, we have separate models for government and for government bonds and corporate bonds, very much taking into considerations that the type of ESG issues that you're thinking about are very different to, say, at the corporate level. So governance institutions, corruption, institutional corruption, rule of law, those don't naturally fit into, say, a corporate model, and it does make sense to have a separate assessment. But where it is important is to not isolate the sovereign or the country level aspect from the corporate assessment. So the way that the MSCI model works, say in our exposures analysis, we look at both the business segments of a company and also the geographical areas that they operate to incorporate some of those country elements to our corporate analysis. And I think that hopefully answers some of your questions.
Thanks, Mervyn. I can come back a little bit on that last question as well, maybe, is that the issuer ESG evaluation sheet that we've launched is actually, we've got a separate content for the sovereigns and separate contents for corporates. And I'd definitely say that for sovereigns, there's more of a political component to it. Touching on Marvin's point is that some of the nuances of some of the issues that you're factoring are very different about financial institution stability, as it were. And the reason we deliberately split the fundamental ESG rating from the investment ESG score is actually, I think we'll start to pick pick up some very interesting observations when you come across SOEs, as it were, in terms of how they might trade in the market relative to some of the risks that they have. Because what we've observed already is that some of the state-owned enterprises, when you're actually looking at valuations, they don't trade as a public company that would be doing. They're actually trading as a proxy to the sovereign. So, and we're finding some of our sort of portfolio managers are investing in that state-owned enterprise, not because they actually think the state-owned enterprise is actually a good quality company. It's just a pick up to the sovereign. It's a cheaper way to get exposure to the sovereign. They know the risk is there, and so the sovereign is there as the ultimate sort of guarantee for that. So it's very different dynamics, and so we've been very deliberate in terms of separating it out to actually explore what will actually come out in the wash, as it were. So I think it'll be really interesting. Can we have 2 more questions? Yep, at the back. Yep.
Can't hear you.
We can't hear you.
Sorry.
Yeah.
Sorry about that. I'm Janine Gilliatt from SASB, and this is a question for Mike from S&P, and it's really more from the perspective of corporate CFOs. So we continually hear from corporates, particularly CFOs, that they're still not convinced that investors are interested in this information. And part of that is because they can't really figure out the impact on the things they care about, like their multiple or their cost of borrowing. And so one of the beauties of credit ratings is the clarity around, they understand what a change in credit rating and how that's going to impact their borrowing cost. Can you see us getting to a day where you can talk to CFOs about how your ESG assessment is impacting their cost of borrowing, and are you having those conversations now?
Thank you. And another question I saw there. Yep.
Hi, my name is Linda Singer. I'm from Angel Oak Capital Advisors, and my question really is, do any of your firms have any current timelines to start publishing credit ratings or sustainability scores for structured credit, excluding green bonds?
Did you catch that last question?
No.
It was, I think there were, where we have any plans to publish the assessments, ESG assessments of credit ratings for structured credit, was that right?
Excluding green bond. Can I just comment? I think it went to S&P, but I wanted to comment on this question of talking to CFOs, because that's exactly what we're doing at the moment. That's exactly the maturity that I'm talking about. Of course, I'm not saying that all issuers are ringing us up today and saying, yeah, we want to discuss this. But when we're talking with issuers at the moment that want to publish their sustainability ratings for investors, and not just in that green and social bond second party opinion sphere, but in any kind of financial instrument, it's not with the CSR departments now that we're having these conversations. It is with the CFOs of these companies that see this as a way that they should be providing information to investors. And it's a maybe small proportion where it's a French-based company. Historically, we have this market in France, in the UK, where we're having these conversations, but it's something that we're seeing globally in terms of the trends and the interest we're getting when we're talking to specifically CFOs within the corporates and the issuers.
Yeah, I'll follow up on that for the question from a lady from Southby. I think we are very much focused now on talking to CFOs, as we do normally as part of our management meeting process for every credit rating, about the ESG issues facing that company, because we can show that there have been a number of instances where ratings have changed related to ESG factors, and we can show the downgrades that have happened, and that leads to a focusing on of minds in terms of what particular risks have led to the downgrade. And is that company itself exposed to such a risk, especially if we take, for example, environmental issues, exposure to, for example, carbon or stranded assets, for example, and that could lead to a very focused conversation about where that company is going to be, in 3 to 5 years' time, and how that's going to affect their credit quality and hence their cost of debt. So we are having those conversations now. We are asking those questions, and CFOs are taking note.
Okay, brilliant, thank you. I've just got a conscious, I know there's that second question, but if there's anybody in the panel who can answer that, I mean, if you find the lady afterwards, as it were, on that side, maybe. I've said I'd only try and keep you 5 minutes beyond the break time, so I'm going to leave it at that and hand over to Carmen. But on behalf of the panel and we'd just like to thank you for coming to this session. We hope you found some of the content useful and sort of thought-provoking, as it were. Thank you.
Thank you. Very, very, very quickly for me to flag a few of the next steps of the initiative. Watch out for the final report of the 3-part series, Shifting Perceptions, ESG, Credit Risk and Ratings, that will come out before the end of the year. We will start talking about the solutions that have emerged during the roundtables. We're also in the process of putting together the next stage of the initiative, which will run from 2019 to 2020. So we'd like to hear your thoughts about what you would like the PRI to explore further, ideas of sectors, of tools that we want to explore more in details. These are my contact details, and this is please the page to bookmark for future updates. Easy to remember, www.unpri.org/credit-ratings. And with that, please join me in giving another round of applause to my esteemed panelists who've done a great job today. Thank you for coming.